everybody, and welcome to Economics with the Honorable David M. Walker, but David will not be on today. Instead, we have a very special guest who's going to be giving us the economic forecast, which he does every year. This is probably one of the hardest things to do, is to predict where the economy is going, which is one reason I don't do it. Instead, we have Dennis Stearns, who's the CEO and founder of Stearns Financial Group. He's also a certified financial planner, and he's been doing this for about a half a century that I can imagine in doing this. And he built a nice little company that had managed about $2.3 billion worth of assets. So he knows a little bit about asset management and planning. So with that, with no further ado, since you don't want to listen to me, I don't predict the future. Instead, we're going to listen to the Honorable Dennis Stearns and listen to him and see what he has to say about the future. Okay, so Dennis, we're going to let you take it away. I'm just going to be in the background.
All right, thank you, Nick. Hello, everyone. So we're going to get into just kind of normal economics this time around, but we're also going to get into the intersection of Trumponomics and the age of disruption, AI, robotics, etc. So get ready to challenge all the economic and investment ideas that you've had in the past, because the world is being turned upside down. So, irrational exuberance. Do you remember this book? And more importantly, do you remember when it came out? So it came out in the spring, March actually, of 2000. So that was at the end of the whole dot-com era. And we definitely had irrational exuberance. We had prices being pushed through the roof, and we had not enough earnings to support them. Well, the good news now is that we have more rational exuberance. We have stretch valuations. We'll get into that in a little bit. But we have earnings that actually support it much better than back in the year 2000. So, you know, things from here on are going to really kind of depend much more on ability of companies to grow earnings for stock investing and for economies to be able to grow over inflation. And, you know, there's good news on most of those fronts. So we believe the U.S. is in a rational bubble. And you might say, well, what the heck is that? Well, a rational bubble is an AI-driven economy that will actually end up with good outcomes on the end in a lot of different areas of the economy. Productivity for companies, healthcare, many things can come out of it that will be great on healthcare. Microsoft Discovery, the new thing that they trotted out within the last year, has some incredible tools for researchers and scientists to be able to essentially jump the curve on new healthcare product, pharmaceutical development, other areas. U.S. economy is in pretty good shape, but it's not robust if you took out that AI capital expenditure spending. And so good news there is the new tax law for the U.S. is stimulative at a modest level, and certain sectors of the economy will have even a little more goose to help them in terms of their tax write-offs. Number 3 item is a big one. U.S. corporate profit margins doing very well. In fact, record high profit margins. And 2026 earnings should support stretched valuations in the stock market up to a point. So this is one of those key times when you start to get a little inflection, and we actually have had this already in the early weeks of 2026, where you have some sectors of the stock market begin to take it on the chin, not because they're doing badly, they're just not doing quite as goodly. They're not doing quite as well as they were. And that inflection point of going from good to a little less good is where you start to get some sector recessions or even corrections within the market. The thing that is a head scratcher for a lot of people is long-term U.S. stock returns are forecast to be zero real return over inflation in the next decade. And that is coming from Goldman Sachs, JP Morgan, Vanguard, and some others. And JP Morgan just sort of doubled down on that long-term forecast. But short-term, they're all pretty positive about, again, the earnings in 2026 and some of the positives in the economy. So this is one of those situations where you want to be on guard against some of the changes that may be coming in the very near future. And finally, everybody knows political wildcard risks are elevated, and in some cases significantly elevated. Now, international economic overview. International economies are generally doing good with some areas of softness. International corporate earnings are improving and support more gains in 2026. International actually beat the U.S. if you were a U.S. investor in international stocks because of the U.S. dollar going down significantly last year. There is a potential for additional decline in the U.S. dollar. So from a U.S. investor perspective, makes overseas investing attractive. Geopolitical and political wildcard risks are elevated overseas as well. And so this is not just a U.S. phenomenon. There are unusual things going on all around the world. And so we believe that this is a time to rebalance your portfolio, broaden diversification, and consider areas like infrastructure, which has considerable legs for the future, estimated $1 trillion with a T, dollars of additional investment needed every year for the next decade just to catch up with where we need to be. And some of that is old-time bridges and roads and other infrastructure. Some of it is gee whiz new infrastructure to support the booming AI industry, energy infrastructure as well. Dividends, they're back in vogue, and we believe that this will be a time to be seeking out good dividends, high quality dividends. Dividends that can deal with a future of a lot of uncertainty relative to AI. And again, international diversification for US-centric investors where they have very little overseas, that hurt some in 2025. We think going forward, it's good to have more of a 3-to-2 balance, three parts US to 2 parts international. And for some people who have a more aggressive portfolio, they may even want to consider a 3-to-3 or a 1-to-1 ratio of US to international stocks. So here's that valuation stretch piece. And, these are typical S&P 500 valuation metrics. And you can see most of them are way over to the right. And if it were not for those profit margins being at amazing levels and earnings being at amazing levels, this would be a very scary chart. So this gets back to what I've talked about in the past. You never look at one number and base your decisions for the future on one number. You always pair it. It's like a wine pairing. You always pair it with something else. And here you have to pair this chart with the potential for earnings to be good and for AI to create a tailwind on earnings in the future. Global equity valuations, you can see over the far left of this chart is the US, and the little triangle, January 1st, 2025, kind of the light blue, and then the purple is the current, so just slightly above where it was a year ago in terms of valuations on the US, but at the high end of the range. Then you look at Japan, Eurozone, emerging markets, and China, Asia, earnings and valuations are more reasonable. So again, this is one of those situations where we think there's going to be some catch up. And part of the reason there's going to be some catch up is that when we look at international companies, they are all over this AI productivity boom. One of our managers in London, their top 20 companies, they rated them A's and B's for being able to have AI productivity help their earnings and dividends grow faster than normal in the next decade. So this is just a good reminder, top 10 companies by decade, that every 10 years, some of the leadership changes. And so the leaders on the far right that we have today, they're all the big Magnificent Seven companies and a few non-Mag 7 companies. And the fact is that a decade from now, we think there will be 3 or 4 of these companies that will be on the list for a decade from now. But some of the other ones will probably fall down into maybe the top 20, top 25 list. And a few of them may be marginalized. Again, we're in the age of disruption. And so the next decade is going to see disruption unlike anything we've seen in our lifetimes. And so one of the big changes, I talked about it a little bit last year, is that many of today's best opportunities are in private companies. And we have just had a significant change in how many public companies are out there. Jamie Dimon, the head of JP Morgan Chase, talked about this the other day, about half the number that there were a decade ago of public companies. Some of that is because some of these public companies are being taken private. And the private companies with really good finances and very strong earnings, I mean, we're talking on this chart, extremely strong earnings. The private companies outnumber public, as you can see on the far right of the chart, by a significant margin. Companies are choosing to stay private longer. And part of the reason is they can get the capital to do that. Well, here you have the long-term returns in private, which is the sort of greenish circle at the top, private investments, and the orange circle are the public markets. And you can see pretty much across the board, higher returns, lower volatility. And we believe that in the future, the S&P 500 has had a great decade. But in the future, is Goldman Sachs going to be right and the S&P 500 will make 3% a year? We think with AI and some other things, maybe that number will be 5, 6, 7. So maybe not quite as dire, but still some of these private things are looking at higher single digits, in many cases, low double digits. Venture capital in particular, for those with more aggressive explore money, is just an area of massive opportunity in the future. It did extremely well in 2025, generally over 30% to 40% kinds of returns. So the question is, can AI and robotics save the day for the US valuations being stretched? And again, the answer is probably. Not completely, but probably. And so they can enhance earnings by 5 to 10% in the future, helping unstretch valuations. And then Penn Wharton's national debt analysis says that AI can add at least 0.5% per year in GDP growth in the United States in the next 5 years. And, one of the 6 ways that you get out of a debt problem is to grow, baby, grow. So let's talk about this AI thing. It's the subject of a lot of speculation as well as attitudes. Now, this particular survey put it in terms of movies that you all have seen. And so 34% of significant wealth managers and investors see AI being more of a Star Wars future, where AI is a loyal and capable companion to humanity. However, over on the left side of the chart, 25% see it more like HAL 9000 in 2001: A Space Odyssey. Now, in that movie, Hal was not necessarily evil. It was simply doing what it thought was best for all the constituencies involved, not just the astronaut. And so that's another issue with AI, is that sometimes it's going to make decisions that might not be the decision that a particular human would like to see. Now, only 8% of the people thought it was going to be Cyberdyne Systems, model 1010. And of course, that's from the Terminator series. Now, again, beyond 5 to 10 years, our crystal ball gets a little foggy about just how fast this all can grow, and when will we get to the point where humans become less critical to the equation. But in the shorter run, we do see it being a 1 + 1 = 3 future, where one human plus one set of good AI skills will create the productivity of 3 humans. Here's the Amazon CEO saying that Gen AI is the most transformative technology of our lifetime. That's saying a lot. This is from my Ninja Entrepreneur book, where I interviewed Amir Hussain, Spark Cognition. He is on boards all across the country and overseas in the area of AI, on major company boards working with AI. And he thinks it will unleash creativity like nothing we've seen in our lifetime. Now, this goes against some of the wisdom or thoughts out there, maybe it's not wisdom, that AI will crush creativity. But it's actually the more creative humans and the moderately creative humans that will be able to use AI to look like they are geniuses. So Ford Motor Company CEO not too long ago said he could operate well with 50% less white collar workers and 3x the number of robots. And therein lies the issue for the future, is that if you could really get rid of 50% of your white collar workers, what does that look like for the future of the company? Now, with your shareholder hat on, you're cheering this. You're saying, "Wow, this is wow! Think of the productivity that would be involved." With your worker hat on, if you're one of those white collar workers, you're looking to the white collar worker next to you and saying, "Okay, are you in the good 50% or the bad 50%?" And so again, this is one of the great upheavals that will be happening. And this is not a decade out. This is already beginning to happen. We're going to see significant issues around this in the next 3 to 5 years. So JP Morgan Chase CEO Jamie Dimon says we have hundreds of AI use cases, and they can identify 2 to 2.5 billion in either cost savings or revenue enhancements. Now, thing to keep in mind with this is with JP Morgan Chase's profitability, that's only about a 4% tailwind. So, nice numbers, but not a game changer in terms of their profitability and how it helps their valuations. But Jamie also says, yeah, we're in the early stages of this, and the numbers should go substantially higher. We did a work with one of our AI partners who has won several national awards in this area a couple of days ago, and we went sector by sector, job title by job title, and the average tailwind in the next 3 to 5 years for companies is probably going to be more in the 5 to 10% range, going back to that earlier slide, and in some cases as high as 13, 15, 18% tailwinds on productivity. So the Federal Open Market Committee, FOMC, of the U.S. Federal Reserve, they actually, in a recent FOMC minutes, talked about the higher productivity growth possibly reflecting an increasing use of AI. And so again, even the governments are starting to wake up to the realization of this is a future that is accelerating at an accelerating rate. Now, this is the one that gives a lot of people headaches in the AI area. It's the circular CapEx spending. If you stare at this chart too long, you may need some Advil. NVIDIA is in the middle of the chart. And what this is basically saying is that all the enablers of the AI future are selling things to each other and creating a bit of a peacock effect, if you will, a rotational increase in revenue that isn't all bookable. So when's the last time we saw this? Well, it was right before the Great Recession of 08, 09, and it was in the finance industry. However, our analysis of what you're looking at on the screen, we're nowhere near what was happening in 08, 09. It is not nearly as scary in terms of the overall trend. Now, it will create significant volatility. So on the bottom right of this chart, you see Oracle. Oracle last year had one of the most amazing rocket ship rides up as it tied in. It had a 5-year earnings forecast that was off the charts. They were doing deals with all the different cats on this chart, and they just soared up, over 50% in a very short period of time. Then, not too long after that, they soared down. They actually retraced that entire ground. So if this were a roller coaster ride at your favorite amusement park, you would have had a nosebleed at this point. And so there's a lot of speculation that Oracle is going to have to borrow a lot of the money to make things happen in the future for their data centers and so forth. And the question is, will they be able to generate enough revenue to properly pay off the debt? In our view, this is not a crisis yet. In fact, we're still within kind of normal borrowing ranges. Many of these companies are making these massive investments out of free cash flow. That's a completely different situation because if you can make it out of free cash flow, there's not quite the short-term pressure to deliver on results. So we consider this rational bubble to be the best of times and the worst of times. We see some really good outcomes in the future. I mentioned healthcare. There's just a lot of amazing things that may be coming down the pike in the next 5 to 10 years. Very likely that every cancer will be a chronic condition 10 years from now. Many cancers that 10 years ago would kill you are now a chronic condition, as long as you get that annual checkup and you catch it early enough. So again, the next decade for healthcare could be amazing. Transportation of people, overall economic performance, education. I'm working with a number of universities on strategic and tactical planning because there is a concern that the unemployment rate of new college grads has risen to 9% in the United States and is expected to rise to 15 to 25% within the next 3 to 5 years. And that's a problem for not only the universities, but also the graduates. How do they get a job? But on the other side, the education tools to enhance education, not just in universities, but in K through 12, are improving at an incredible rate. And so those of you who know the Cone Academy and some of the early work they did, you've not seen anything yet in terms of what's going to be coming in education. Now, again, in the worst of times category, wealth inequality will probably get worse. Political rancor will get worse. Warfare will get worse. Civility will get worse. So again, it's a mixed bag. So these are the three main areas to invest in AI. The enablers are your typical companies that are talked about in this area, whether it's NVIDIA or Google, Alphabet, or Microsoft. The enhancers, the ones that work with the technology coming out of the enablers to connect it to the end users. And the end users are all the companies all around the world, not just in the US, that can incorporate these AI technologies to optimize operations and enhance business performance. This is one of the more interesting areas for us, and in many cases not as stretched valuations as those enablers at the top of the page. So the Honeywell CEO kind of doubles down on this concept that industrial AI, meaning end users in the industrial space, will be the unsung hero of this revolution. And the CEO of Walmart not too long ago said, yeah, it's very clear AI is going to change literally every job. Now, people in general don't like change, but this is where change is coming very quickly, and we all need to be prepared for it. So yeah, let's go to that next page. So some of these jobs on the right-hand side were considered bulletproof not that long ago. Coders, computer coding, which a lot of it's being done by AI now, and they don't need as many coders, copywriters. And so many of these jobs on the right-hand side are being retooled already. And we're early innings on AI, are being retooled already into these new positions that didn't exist before on the left-hand side. And so there's, almost for every job that could be eliminated, there's something in the new category, but that requires that someone be open to change, open to pivoting their career. And those who are open to it will do better than those who are laggards. And, we mentioned down at the bottom right on the threat category, what jobs would a smart robot like Optimus coming out of Tesla, very soon, by the way, with fine motor skills. So they've been having some challenges with those fine motor skills of Optimus. They're getting through a lot of those challenges. What jobs would that disrupt? We saw some early prototypes, even in the plumbing industry, which everybody would consider a plumber to be pretty much bulletproof for the AI future. Not so fast. So again, I think almost every position is going to have to up their game in understanding, back to the 1 + 1 = 3, they're going to have to understand AI, know how to use it to remain relevant and paid well in this new future. So this is one that stay tuned, because inflation has been the big problem since COVID, supply chain disruptions and some political missteps. That is largely under control, but under control at a bit higher level than we're used to. But deflation, which comes from a lot of this technology productivity, is coming big time. And so the kinds of things that governments are going to do may be more inflationary, but the kinds of things the private sector and technology is going to do more deflationary, and it will be the King Kong versus Godzilla battle of the century. We think that generally they will equal each other out, but there will be bouts of occasional higher inflation, probably not hyperinflation, but occasional higher inflation, and bouts of deflation, which most people don't even know how to act in a deflationary environment because we've had so few of them in our recent lifetime. So our strategy for 2026, stay disciplined, know what are your core assets for your financial independence, and separate them from your explore, that you could be a little more frisky with some of these areas of technology and enablers or whatever. And if they don't work out, you don't worry as much. It's not taking food off your table someday. But definitely you know your core assets and have that right balance. It's the right balance between offense and defense. We would say risks are elevated in many areas. And so again, broaden that diversification. And if you have to pay some taxes to broaden the diversification, that is the price of sleeping better at night. Uncertainty level is high. We see this going company by company on individual stocks, that companies that had low uncertainty now, in many cases, have been bumped up to medium, and medium in some cases to high. And so in an environment like that, you want to have more bird in the hand solutions, which means things like bonds, not exciting, but stable, or high quality dividends. And then opportunities abound for more aggressive explore portfolios. I mean, we probably have more opportunities for that aggressive side than we've had in a long, long time. So, again, best of times, worst of times, a lot of opportunities in this upside down future that we're coming into. And given the lower projected returns in the next decade that Goldman Sachs and others have suggested from a traditional portfolio, that's where you have to think about different asset classes, and you have to get outside your kind of normal stock and bond kinds of things and consider other diversifiers. So I hope that there's been a few nuggets here for everyone to think about. And, with that.
Yeah, well, we want to thank you, Dennis, from Dennis Stearns from the Stearns Financial Group, who's managing like $2 billion worth of assets. And we want to thank our viewers who are watching this, the certified financial planners, the financial advisors, the people from the United Nations, and people from around the world. And we'll see you next time on Economics with the Honorable David M. Walker. This is a special edition with Dennis Stearns at Stearns Financial Group. And we'll see you next time next week. Take care. Bye-bye.